Welcome back to our second and final presentation for financial ratio analysis. And in this presentation, we will also find what errors I've made. So get out your calculator because you're going to check to make sure I didn't screw up, because I always do. I always make lots of errors, and I check my errors at least check my calculations at least 2 or 3 times. But even still, so get out your calculator. If you can, print out those or have them readily available. The balance sheet and the income statement for Sprouts Family Markets. We're going to do the rest of the financial ratios. Now, the truth is, once you've done a few of them, you can do all of them, assuming you can find the items on the balance sheet and the income statement. But let's see, let's do it together. The profitability ratios are financial ratios that measure a firm's returns by relating profits to sales, profits to assets, or profits to equity. And the uh, the the two that are often uh, promoted and displayed are the net profit margin and the operating margin. And then the next three are actually very popular: return on assets, return on equity, and return on invested capital. You don't see the gross margin in Yahoo and in MarketWatch that often, but it's very easy to calculate. Once you've done a few, you've done them all. Profitability ratios allow one to measure the ability of a firm to earn an adequate return on sales, total assets, equity, and invested capital. So let's take a look at the first. Now, by the way, I don't think I mentioned this. There's a formula sheet that has all these uh, ratios on it. So make sure you. I think it's a good idea to print it out just to have it with you. But of course, you just look it up. It's online. The net profit margin, also called the after-tax profit margin. This is the rate of profit being earned from earnings after expenses and taxes. So there's that bottom line number. Remember the net income on the income statement? Divided by the top line number, the total revenue. So if we run on over to the income statement, where is that income statement? There it is. We take the bottom line number, 261,160, and divide it by the top line number, 64,000,000. Now, remember, everything's multiplied by 1,000, but your calculator probably, if you have a 99-cent calculator, doesn't go that high. So just do the bottom line number, 261,160, divided by the bottom line number. I'm sorry, the top line number, 64,000,000. And let's see what I get. Let me make sure. You got it. You have to keep me on my toes because I make a lot of mistakes here. What did I get? Come on, come back, come back, come back, come back, little Sheba. Okay. Let's see. I did that net profit margin. I got 4.08. Is that what you got? Come on, stop. Can we pause the presentation? Make sure you do it. And if you check other sources, you might get a number that's a little different, right? And I checked Yahoo and they gave me 4.08. So I felt pretty comfortable that I was in the ballpark. You again, different sources have the financial statements a little differently. So you might wind up with a number that's a little bit different than other people. Now, again, we talk about how important it is to check our competitors and check the industry. And of course, the higher the better. So is 4% a decent net profit margin for Sprouts Family Market? I don't know. We have to look at their competitors. But the retail industry is so competitive and so balkanized, broken up into different parts, that it's difficult. We no longer can find out. Maybe Amazon will. I don't think they do break it down, because Amazon now owns their major competitor, Whole Foods Market, and Trader Joe's, which is not quite a competitor but very close, is privately held by Aldi Corporation. So we probably have to take a look at Krogers and Safeway, and those are much bigger, much different types of grocery stores. So it's a little difficult in this case, but still, we need to look at their competitors. And for a grocery store, I'm thinking, I've never worked, well, actually, I did a million years ago in a store where I was always stacking Pampers and diapers and milk cartons all the time. I think 4% is probably pretty decent because remember, they sell milk every day, right? It's not like a car dealership or a high end jewelry store or something like that. They're selling these products all the time. Yeah. So I'm thinking 4% is not bad for a company like Sprouts, but we need to do our research. The next one is the gross margin. Ooh, gross. Now it uses gross profit. So we take the gross profit, which is on our income statement. You want to go into the gross profit there? There it is, 238000. And we divide that into the net income, 261160. See, this is the hard part. It's finding the numbers. And then once you've found the numbers, it's pretty straightforward to do the calculation. So we take the gross profit divided by the total revenue. I'm sorry, did I say the net profit? Total revenue. Again, we did the previous one was net profit divided by total revenue. This is gross profit divided by total revenue. And let's go back and get that total revenue because I told you make a lot of mistakes. 6400000. And let's get back to the presentation. Come on, sweetheart. Gotta be nice. Gotta be nice to you. What happened to it? It disappeared. No, it didn't. There it is. Ay, 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 ay. So we take that gross profit of 2382000 divided by the total revenue 6400000, and we wind up with a gross margin of 37%. Now, this actually makes sense because when you're a retailer, you are buying, not a couple of gallons of milk, you're buying thousands and thousands of gallons of milk. So you get tremendous discount compared to what somebody who is a retail customer. And in many stores, you look around and you think, well, these people are paying about 30-40% less than what I'm paying. Well, they got to pay the rent, they got to pay the employees, they got to make a profit. And they buy in bulk. So it makes sense. Their gross margin is 37%. And we have to look at their competitors and the industry as a whole to see if that's actually a good number. I'm thinking it's probably a decent number for a company like Sprouts. And then the third one, which, by the way, the gross margin, you don't usually see that published too commonly on the internet sites. But the net profit margin and the operating margin you often do. So this same idea. Take that operating income now and divide it by the total revenue. So if we run on over to the income statement, our operating income is 352,580, and we divide that by the total revenue of 6400000, and we wind up with what did I get? 5.51, an operating margin of 5.51. If you look at Yahoo, they say 5.72. So obviously they're doing a little bit different calculations on their operating income. And yeah, you guessed it, the higher the better. Varies greatly from industry to industry. So when we are looking at a specific company, we always need to look at its competitors within the industry. When we find a company that is atypical of its competitors in the industry, it's a single signal that we have more investigative work to do. It's not, oh, don't buy it. Oh, yes, buy it. It says to us we need to further understand the business, further understand the competition, to understand why it's so different. Got it? Okay. So we've done 3, right? The rest are all like it, right? The rest are very similar. Yeah. How was your day at work, dear? Slide number 25. Very popular ratio is the return on assets. We take that bottom line number, which is from the income statement, and then we divide it by the total assets. It's a measure of how profitable a company is relative to its total assets. Return on assets looks at the amount of resources a company needs to support their operations. It reveals how effective the company is in generating profits from the assets it has available. And of course, the higher the better, but we look at the competitors. So do you want to, yeah, let's do it. We know the net income. Remember that number was that was 261, yeah, 261,160. But where's the total assets? That's on the balance sheet, right? So we got to run on over. Let's go get the balance sheet. We got to go to run over to the balance sheet, and we see that the total assets are 3466000. So you got that number, 3466000. So let's go back to the presentation, and let's see what I got here. Net income 261,160 divided by the total assets of, where did it go? I just had them written down here. Total assets. Where did they go? I just lost. Oh, there it is. 3466000. Okay, and what did I get for return on assets? 7.53. 7.53. Now, if I went to Yahoo, they had 7.64. Close enough, close enough. They're probably doing a little different calculation, but same idea. The numbers are very close. Return on assets, look, oh, we read that already. We did it. And of course, the higher the better. It's a very popular ratio. Look at their competitors. The next one is a wrinkle on return on assets called return on equity. This is a measure of the overall profitability of a company in relation to the shareholders' equity. In other words, of the worth of the company minus the liabilities. So it's the same formula, except instead of using total assets, we use total stockholders' equity in the denominator. Take the net income and divide it by the total stockholders' equity. Because return on equity uses stockholders' equity instead of total assets for the denominator, return on equity is sensitive to the amount of debt a company is carrying. Specifically, if a company carries a great amount of debt, the return on equity is going to be much larger than the return on assets. Now, you'll hear investors and pundits say, you're using other people's money to make your money. You know, that's fine. Some investors view this positively. Others, your humble instructor included, are worried about the possible negative consequences of too much debt, because debt is it's called leverage, and we're going to use that term later on, and we're going to use it the rest of the semester. It is like a lever to increase or magnify your returns. But if debt becomes too much, you wind up in bankruptcy. Things are not happy. Yeah, so you got to be careful, in my humble opinion. Some people are very debt averse. Other people are, no. Load up. We want to load up on debt. Use other people's money to make your money. So that we're going to see a big example right here. If you remember, the net income was 261,160. And now if we go to the balance sheet, back to the balance sheet, and go down, we see the total stockholders' equity is 1050000. Now, it looks kind of confusing because you would think that these two numbers would be added. But see where it says retained earnings are included in the common stock equity. So 1050000. So we go back to the presentation. There it is. Whoops, that was a mistake. I didn't want that. Go back to the presentation. The presentation's gone. I deleted it. Oh, there it is. It's back again. Oh, boy. Me and technology, we have this not so great relationship sometimes. Anyway, yeah. So we take the net income, which remember is 261,160. We divide it by that 1050000, and we get a return on equity of 24.87%. Wow, that's a lot higher than the 7.5% return on assets, isn't it? Right. So what has happened? As we said in the previous presentation, in 2018, interest rates were so low, not only Sprouts Family Markets, but many companies loaded up on debt, and so their return on equity skyrocketed. By the way, I looked at Yahoo's, and they give it 26.03. So I don't know, something's a little different. Well, I have a funny feeling that our 1050 total stockholder equity is actually, it's rounded up quite a bit or rounded down quite a bit. Okay, got it? Now, another profitability ratio that is very popular is called return on invested capital. The little weird thing about this is that there are a few different ways of calculating return on invested capital. It's used by many long-term investors, and it's one of Warren Buffett's favorite ratios to take a look at. It's a measure of the overall profitability of a company in relation to both the debt and the equity. So we take the net income, subtract the dividends. Well, Sprouse doesn't pay dividends. And then you add the long-term debt to the total stockholders' equity. As we said, there are a few different ways of computing it. This is the most simplistic version. By using both long-term debt and the stockholders' equity, the return on equity measures how well a company is managing all the capital that the company needs to earn its profits. So not only the stockholders' equity, but also the long-term debt on the books. And this is our friend, the net income, the bottom line, 261,160, right? The long-term debt, where do I have that? Is 1400000. Now, you don't trust me? Let me go look. Where's the balance sheet? There it is. There it is. Long-term debt, 1400000. And then our stockholders' equity is 1050. So do those calculations. And let's see what I got here. I got a subtotal. The numerator stays at the net income because they don't pay any dividends. And then the long-term debt and the stockholders' equity, I got a subtotal. Where is the subtotal? 2450000. Make sure I did it right. I make a lot of mistakes. Come on, check me. And we got a return on invested capital of 10.66%. Now, many investors really want to see a return on invested capital of at least 10%. They want to see the company at least earning 10%. And of course, we want to look at the industry, look at their competitors. But I'm happy with earning 10% on my money, aren't you? So those were the profitability ratios. Whew. Well, folks, should we continue to bounce back and forth with the balance sheet and the income statement and the other financial statements, just to make sure that Payano did it right? I'm going to ask you to do these calculations. I'll give you the answers. Relax, I'll give you the answers. At least my answers, because they might be wrong. You never know. At least I usually make mistakes, at least one. So let's continue with the liquidity ratios. These are financial ratios concerned with the firm's ability to meet its day-to-day operating expenses or obligations and satisfy its short-term obligations as they come due. In other words, can you make payroll? Can you pay the rent? We have these short-term, and remember the accountants call them current, bills that have to be paid. So how are we doing? Do we have enough cash on hand? So the current ratio is the ratio of the current assets to the current liabilities. The net working capital is a little bit of an oddball. It's not actually a ratio. It's actually it's a subtraction, actually. It's arithmetic subtraction. But it's very similar to the current ratio. And then the acid test. Ooh, what a great name. It's just another version of the current ratio that removes inventory from the calculations. And we use the balance sheet. So let's take a look at the current ratio. This is a very popular ratio because if your current assets equal or exceed your current liabilities, you're going to be able to satisfy your short-term obligations without any problems. Obviously, the greater the number is, the better. Anything over 1 is considered acceptable. But then you get companies with cash coming out of their ears like Google and Apple and Microsoft, and their current ratio is like 2,000. That's the power of being the only kid on the block in certain sectors of the economy, especially technology. So let's go over it. Let's quick do this, guy. Let's go into the balance sheet. And what are our current assets? Well, they include cash and accounts receivable. And what's that? Well, that we'll talk about that in a bit. Inventory, other current assets. So 673,800. What are the current liabilities? Well, that's accounts payable, money we owe, short-term or current long-term debt that's coming due, and other current liabilities, 522,380. So if we take the, I'm going to hopefully not mess up. Here we go. Yeah. If we take the 673,800, the current assets, divided by the 522,380, we get a current ratio of 1.29, which we said anything above 1 is, it's fine. And so we know that Sprouts is not going to go through bankruptcy anytime soon. They will be able to pay their employees and the rent and all the other things they have to pay. Now, the net working capital, as we said, is the oddball. It's not in a ratio. It's an absolute dollar measure of liquidity. What we do is we take the current assets and subtract the current liabilities. So, in other words, we're saying, all right, we did a ratio of how much assets to liabilities. How much cash above your liabilities do you actually have or not have? If the current ratio is greater than 1, then the net working capital will be positive. Why? Because the current assets will be greater than the current liabilities. If it's the other way around, the current liabilities are greater than the current assets, the net working capital will be negative. And of course, the higher the better. It's less popular than the current ratio, but it gives you an idea of how much extra cash they have in case of an emergency for current liabilities. So if we take the 673,300 minus the 522,380, I get net working capital over $150 million. They got an extra $150 million lying around to pay any short-term debts that may come due, short-term obligations. 151,420. So make sure I got it right. Come on, check, because I make a lot of mistakes, okay? Now, this one, what a great name. Acid test ratio, or also called the quick ratio. This is a more stringent version of the current ratio. And you'll often see the formula like this. Cash plus accounts receivable plus short-term investments and other current assets. That's just too much work. All you really got to do at the bottom, here it shows you, is take the current assets and subtract the inventory. Because that's all you're doing, right? Unlike the current ratio, the acid test ratio excludes inventory. This ratio measures the ability of the company to meet its short-term obligations, even if the current inventory becomes obsolete, undesirable, and hence difficult or impossible to be turned into cash. And of course, anything greater than 1 is considered adequate. So you see what's going on here? What happens if all of a sudden the computers that you own in your inventory, your computer company, are obsolete? Nobody wants them. Can you still make your payments? That's why computer companies now don't keep inventory. They build them as they need them because they know in 6 months the thing is obsolete. But a company like Sprouts, is food become obsolete? Now, it might spoil if everybody disappears. The customers don't come and buy the stuff, but it's not going to become obsolete. And obviously, I don't think Sprouts is worried about this. But if we do the calculation, if we subtract out the easier one, subtract out the inventory from the current assets, I get 363,250. I divide that by the current liabilities of 522,380, and our acid test ratio is only 0.695, a little about 70%. If it were a company like a car company that models become obsolete because the new models come out, nobody wants to buy the old cars, or the computers, we might be a little worried. But with Sprouts, and we're going to see another indicator, another ratio called the inventory turnover. And we'll see that really will assuage any qualms, fancy words for saying it'll relieve our concern that the acid test ratio is less than 1. And with a lot of companies, it's often less than 1 because their inventory doesn't go obsolete. Thank you very much. So those were the liquidity ratios. How are we doing for time? Not bad. Are you still awake? Okay, good. Because we still have a couple A couple more to go through. The activity ratios. Activity ratios are also called efficiency ratios. They are financial ratios that are used to measure how well a firm is managing its assets. We're going to take a look at the accounts receivable turnover, the inventory turnover, which we just mentioned, and the total asset turnover. These ratios use data from the balance sheet and the income statement. Activity ratios measure a firm's ability to convert different accounts within their balance sheets into cash or sales. Companies will try to turn their production into cash or sales as fast as possible because this will generally lead to higher revenues. So let's take a look at the first one, the accounts receivable. Now, what are accounts receivable? If you haven't taken accounting, maybe you've heard the term, it's just money that is owed us. It's money that's coming in the door. It's not there yet. It's receivable, but we haven't gotten it yet. And this is a measure of how well they are managed. We take the total revenue, our top line number, and divide it by the accounts receivable, which is on the balance sheet. So the higher the number, the better. It indicates the return a company is getting from its investments in accounts receivable. By maintaining accounts receivable, firms are indirectly extending interest-free loans to their clients. A high ratio implies that the company operates either on a cash basis or its extension of credit and collection of accounts receivable is efficient. A low ratio implies that the company should probably reassess its credit policies in order to ensure the timely collection of imparted credit, which is not earning interest for the firm. Or that may just be how the industry operates, the defense industry. You know, Uncle Sam does pay his debts. Don't worry, he'll get paid for that aircraft carrier. But when I worked many millions of years ago, they called us sand crabs because we weren't in the military. We were contractors, and we did our best to make the military more efficient. I was one of those logistics types persons, and it was just de rigueur that Uncle Sam would pay you, a year or two later. You're very rare. You got paid. Well, at this time, this was 1970s, early 1980s, there was a big move by Congress to say to the Defense Department, come on, we want you to promote small business. We want you to get more vendors that are small business, not just these huge corporations. You've heard the military industrial complex and all that. And so the Defense Department said, okay, so they put out the bid as many as they could to small businesses. And small businesses responded. But small businesses weren't ready for what happened next. Come on, guys, you're going to pay us in 90 days, right? No, we'll get back to you, maybe a year. And the small businesses said, no. We can't do business like this. We got to make payroll. So my understanding, and of course I haven't been involved in the military other than teaching and talking to people in the military, and which I enjoy thoroughly. It's gotten a whole lot better. Uncle Sam pays his debts a whole lot faster now. So let's do the calculation, right? We already know the total revenue. That's that $6,400,000,000. Let's go to the balance sheet and find accounts receivable. Well, boy, considering the company sold $6 billion worth of goods last year, their accounts receivable are meager at $34,260. So let's see if I can get back there without messing things up. So we take that total revenue, 6,400, and divide it by accounts receivable of 34260, and we get a turnover of 186. So in other words, every 2 days, Sprouts is turning over their accounts receivable. They don't have anything to worry about because they have very little in accounts receivable, and it's coming back at them very quickly. Now, what about inventory turnover? Inventory is an issue, right? If you're a car dealership, sure, you want a lot of inventory on the lot so people will come in and take a look at the cars. But they're not making you any money when they're sitting on the lot. You still got to pay for them. Normally, you have to borrow the money to buy the cars that you haven't sold yet. And so you really want as little inventory as possible. It's a push-me, pull-you situation. We take the total revenue, and instead of the accounts receivable, we divide it by the inventory. The higher the number, the better. The less time an item spends in inventory, the better the return the company is able to earn from funds tied up in inventory. As with all ratios, This ratio must be compared against industry averages and their competitors. I think I said that, yeah. A low turnover implies poor sales and therefore excess inventory. A high ratio implies either strong sales or ineffective inventory buying and maintenance. High inventory levels are unhealthy because they represent an investment with a rate of return of 0. It also opens up the company to the troubles in case of falling prices or obsolete products. So this is why, as we said, computer companies, Dell was the one that really pioneered this back in the 1980s. They designed and created the computers, but then they would advertise them, and they wouldn't build them until you or the businesses, the customers, would order them. Called just in time. And other companies and other industries followed suit with just-in-time inventory and just-in-time parts and everything. And everything was working hunky-dory, efficiency until COVID came along and threw a severe monkey wrench into this situation. You've heard, I no doubt, the global supply chain, 178 container ships off the coast of Los Angeles and Long Beach waiting to be unloaded. What a mess, yeah. So yes, inventory turnover is important. So let's take a look at we know the total revenue. That's that 6400000 number. Let's go back to the balance sheet and take a look at inventory. Where's inventory? Here it is, 310,350. So let's do that calculation. Go back to the presentation. Let's see. Okay, 64000 divided by 310,350. And that gives us an inventory turnover of 20.609. So in other words, if we divide that into 52 weeks, in other words, they are turning over their inventory every 2.5 weeks. Yeah, 2.5 weeks, right. So, I mean, you walk into a grocery store and you think, oh, everything's here, right? Well, if you are there at nighttime or during the day, when the people are feverishly trying to restock the shelves, you would realize that the turnover is very, very high. Some industries, no, not so much. The inventory turnover is very low. But this gets back to our concern with the asset test ratio. Remember, we were a little worried because the asset test ratio was under 1.0. We don't have any. Sprouts doesn't have, or we as investors in Sprouts don't have to worry about that, because they're turning over their inventory quickly. Thank you very much. Okay, and then the last activity ratio is the total assets turnover. We take the total revenue and divide it by the total assets. So our revenue is that top line number, 6400000, and the total assets, as I remember, they're back on the balance sheet. Where do I have them? I have them written down here, my cheat sheet. Total assets were 3466000. So the total asset turnover is 1.84. So essentially, that almost 2. They're turning over their assets about twice a year. The total assets turnover measures the firm's efficiency at using assets to support sales and revenue. The higher the number, the better. Companies with low profit margins tend to have high asset turnover, and those with high profit margins tend to have low asset turnover. Cool? And of course, we look at their competitors and see what they're doing. So I like that inventory turnover, me, myself. That's a favorite one of mine. So now, slide 36. Our final group is the leverage ratios, also called the solvency ratios. These are financial ratios that are used to measure the amount of debt being used to support operations and the ability of the firm to service its debt. So the debt to equity ratio times interest earned, debt to total assets, and total debt to capitalization. These ratios use data from the balance sheet or the income statement, or both. And the debt, as we've said, is often referred to as leverage. The idea is that you're using other people's money to make money. You're using the borrowed money as a lever to increase your earnings. When one firm buys another firm using borrowed money, it is often referred to as a leveraged buyout. And if you followed the drama of Elon Musk and Twitter last year, you'll know that he borrowed heavily he sold, of course, some of his own assets, but he borrowed heavily to buy and take private Twitter. Interesting. So let's take a look at the debt to equity ratio. This is a measure of a company's financial leverage calculated by dividing long-term debt by shareholders' equity. It indicates what proportion of equity and debt the company is using to finance its assets. So these are on the balance sheet, the long-term debt and the total stockholders' equity. A higher debt to equity ratio generally means that a company has been aggressive in financing its growth with debt. This can result in lower earnings because they have the additional interest expense and hence lower taxes. Sometimes investors use total liability instead of long-term debt because they want to know what's going on with the current debt. The lower, the better for us more risk-averse investors, whereas more risk-tolerant investors would say, don't worry about it. They can make their payments until they can't, right? And then that's a bad situation where they go into bankruptcy. So if we go back to the balance sheet, let's go back to the balance sheet very quickly. We've got our long-term debt of $1,400,000, and then what was the other one? All of a sudden I forgot. I'm getting blanking on that. Blank. Yes, the total stockholders equity. Duh. And so we go down to the bottom and get total stockholders equity of 1050000. And what do we get here? What do I get? Total debt to equity ratio 133%. Why? Look, their debt, their long-term debt is more than their common stockholders equity. Businesses tend to want to keep it under 100% why does it do that? 100% in my humble opinion. I personally like to keep it to 30 or 50%. Certainly that's what we teach in the personal finance class, but I'm not a CEO or CFO at a major publicly traded corporation, so I should keep my mouth shut. But that scares me. We're going to see, though, that Sprouts is not worried at all. That was so cheap. Hopefully they locked it in at that. Hopefully it wasn't a floating interest rate, or else they're in big trouble because interest rates have doubled and tripled in some cases. And here it is, folks. Here we're going to find out why Sprouts is not worried in the least. This is the times interest earned leverage ratio. And when you read eventually the Intelligent Investor, now don't read it as your first book because it'll scare the living daylights out of you. Well, he's so opaque. It's hard to understand him, and he's very flowery, and he's very, very risk averse. More than I am, which is hard to believe. But he was the master at using financial ratios, and none more than the times interest earned. This is the measure of the ability of a company to meet its fixed interest payments. You take that earnings before interest and taxes, and you divide it by the interest expense. It's usually used to determine how frequently interest payments are earned by the company during a year. The higher the better, obviously, and 3 or 4 is considered adequate. So if we go to the income statement, come on, sweetheart, where's the income statement? There's the income statement. And we take the interest expense, 11070, and the earnings before interest and taxes, 360380. And then what do? We go back to this guy. Why is it not disappear? Oh, did you ever have one of those decades? How about if I just minimize that? That'll work. Okay, there it is. If we take the earnings before interest and taxes, and what was that number again? 360380. We divide it by 11070, 11,070,000, and we get times interest earned of 32.5. So remember, 3 or 4 was considered adequate. This is why Sprouts is not worried about loading up on debt. Every 2 days, 2.5 days, every 1.5 days, right? You divide that by 52 weeks. And divide that into 52 weeks because it's 32 times a year, every day and a half they're earning enough money to pay for their interest payments. Yeah, that's why they're not worried. It's as if you and I made our enough in 2 days to pay our mortgage for the year. That's why Sprouts is not worried. I'm worried, but they're not. And they're the ones writing the checks. So eventually, read One Up on Wall Street, Random Walk Down Wall Street first, either one of those or both, and then read The Intelligent Investor. Now, the cool thing about The Intelligent Investor now, the newer editions, starting with 2003, is that a very good writer by the name of Jason Zweig wrote commentary. So after you read every chapter and are thoroughly confused or scared to death or whatever, or just what did he say? There's a commentary, and you go, okay, this is what old Ben was trying to say here. And he does a very good job of it. I applaud Mr. Zweig, because as important and phenomenal as Benjamin Graham's writings are, he needed a very good editor. He really needed a good editor to say, come on, you got to make this easier to understand for the vast majority of us working grunts. Slide 39, total debt to total assets. This is a measure of how much of a company's total assets have been financed by debt. You take the total liabilities, which are on the balance sheet, and the total assets, and it includes both short-term and long-term debt. If it varies substantially from that debt to equity ratio we looked at, the company may be relying heavily on short-term debt. A heavy reliance on short-term debt can denote more risk. It's as if you're financing your company with credit cards. Now, some startups, that's what they do. They go to the bank. The bank says, no, we're not going to lend you any money. They're not big enough to go to the capital markets. They might go to their friends and family and get a few little, but no, they need that loan now. But it can be very dangerous, right? And so total liabilities and total assets, I got them on my little cheat sheet here. Total liabilities were, where are the total liabilities? Where did they go? Did you ever have one of those decades? Where's the total liabilities? Oh, 2,380,000,000, and you divide that into total assets of 3466006, and you get 68.67%, about 70%. Again, people like me like to have it a lot less, 30 to 50%, but hey, they're not worried, obviously. And we have to look at their competitors and see what they're doing. And then finally, our last ratio is very similar, total debt to capitalization. This is a measure of the total amount of outstanding company debt as a percentage of the firm's total capitalization. And what is capitalization? It's just a fancy word for how much debt, how much equity you have on the books. So you take your short-term debt and your long-term debt, add those two together, and then you add on the denominator, make sure you do the numerator first, then the denominator, then the division. Short-term debt plus long-term debt plus the shareholders' equity. So what did I get here? I got the short-term debt is 136,660. Check it out. Make sure I did it right. Long-term debt of 1,400,000, and that gives us in the numerator 1,536,153,600. And then when we add the three numbers in the bottom, 136,600, 1,400,000, and then the stockholders' equity of 1,050,000, we get a denominator of 2,586,600,000, and our total debt to total capitalization is above 50%. It's 59%. It's not really that different from the total debt to total assets. But in somebody like me's situation, I get a little nervous. My motto is make love, not loans. But hey, everyone's different. That's why there's chocolate and vanilla, and some people like strawberry. Plus, I'm not wielding Sprouts and other publicly traded companies' checkbooks. So I'm worried about my own checkbook. Cool. And those were our financial ratios. Again, just to beat you over the head one more time, none of these ratios can be looked at in a vacuum. We look at it as a stew, and we compare these with the industry as a whole, with the competitors, and the market as a whole. And it rounds out the investigation, the research that we started with the dividend discount models and any other models you might use, cash flow models, earnings models, and the likes. Great. So we've done the heavy lifting. My apologies. We've done the heavy lifting. It's now time to take a look at a little bit of silliness. Not too much. Chapter 7 has a lot of silliness. But in Chapter 6, we ask a very simple question. Can anybody beat the market? Who can beat the market? By looking at what is called market efficiency theory. So get ready for some actually good information about us as investors and some of the ways we sabotage our own investing, and market efficiency theory, which in many cases I think is kind of bogus, but we'll see, you'll see. And then, this is very cool, we'll take a look at some all-stars of investing, because I've always thought, if you want to do something well, go look at the people who do it well and copy them and do the best you can to be like them. So we'll see you in our next chapter on market efficiency theory, who can beat the market. Once again, we thank you for being in our class. We are humbled, honored, proud, grateful, and happy that you're with us. Think of how much you have learned.